It's Monday, July 13th. I'm your host, Jason Moser. Joining me today, my financial partner in crime, certified financial podcaster, and certified financial planner, Matt Frankel, CFP. There you go. You like that, Matt, don't you?
I do. How are you doing today?
I'm all right, man. It's it's a new week, and I'm excited because I get to travel down to Georgia later this week to go see my mom and dad. Haven't seen them in a while. I get to play a little golf with my dad and enjoy a couple of days off. Unwind a little bit. It's kind of a stressful year for some.
Yeah, a little bit. I finally got out of town this weekend. It was the first time I didn't sleep in my own house since February.
Yeah, and how did you feel about that?
It felt weird at first, but I gotta give a shout out. I was at the Harris Cherokee Casino in North Carolina. It's up in the mountains. Really cool place to stay in the middle of nowhere in the mountains. And I was nervous at first, and they really did a fantastic job of making people feel safe and comfortable. I didn't see anybody without a mask on or even giving a hard time. We've all seen the Facebook and Twitter videos of somebody throwing a fit in a store for being asked to wear a mask, and we just didn't see that.
That's good.
Yeah, I mean the cleanliness was just off the charts. There were guys in giant backpack yard sprayers with disinfectant hosing down things as soon as people got up. You weren't allowed to sit in a chair until someone had cleaned it and put a sticker on it. It was very impressive, and everyone was just seemed honestly happy to be out. So I got to give a shout out to Caesars, the parent company of Harris Cherokee, for really taking the COVID precautions seriously and making everyone feel safe and comfortable and getting me out of my house for a weekend. So
yeah. Well, I mean, that's really good to hear. I mean, that is something where I'm sure it'll be different in different pockets of the country, but it's nice to see him taking it so seriously. And I mean, at the end of the day, really, it's up to all of us to do what we can. And so it sounds like a lot of people there were doing what they could, and that makes it for a more enjoyable experience for everyone. And speaking of enjoyable experiences, Matt, I mean, I think today's podcast is going to be second to none because we're talking about a company that hasn't even gone public yet. We're getting this thing on the radar early. On today's financial show, folks, we're going to jump into rocket companies. Now, if you're not familiar with rocket companies, my bet is you are familiar with Rocket Mortgage or Quicken Loans. That's what this is. Rocket companies recently filed as S1 to go public. And as I mentioned, you probably know this for Rocket Mortgage. That's their flagship product. Matt, we all know, I mean, how important housing is to our economy, the opportunities it presents from building to lending to home improvement, giving consumers the ability to spend. I mean, I have to say, I was pretty excited to see this filing and having worked in the lending industry before. I mean, you just know how powerful it is and you know how big of a market is and the opportunity that exists there. So let's just start out first. Tell us a little bit about what Rocket Companies does.
Well, they are they're the U.S. Market leader in mortgage originations. They have a little over 9% of the mortgage market, which doesn't sound like a ton, but like you mentioned, this is a huge space. Just to kind of give you an example or a statistic, in 2019, there were $2.2 trillion of mortgages originated in the United States. So a 10% share, that's pretty big.
Yeah.
So they make money from mortgage originations. They also have a servicing operation. They don't actually own the mortgages. We'll get into that in a little bit. They have a servicing operation. They have a small personal lending business. They have a small auto lending business. But at the core of it, they're really a mortgage originator. And they are really trying to take advantage of the inefficiencies in the traditional mortgage market. If anyone's applied for a mortgage, it's not a quick process.
It is not.
I did my first one, I think, through Wells Fargo. I did one through a bank called Iberia in South Florida. And it's a complicated process. And especially if your lender has not yet figured out how to leverage technology to their advantage. The document processing could be really inefficient. The information requests, just the whole process was very inefficient. So Rocket wants to make the most kind of seamless, most user-friendly, most a mortgage process that doesn't make you pull your hair out along the way, which you're a homeowner, you know all too well how that is.
Yeah.
They've been successful so far. Their consumer satisfaction scores are off the charts. Their app has almost a perfect rating in the Apple App Store. They're doing a great job of it, and like you said, they've boosted since Rocket Mortgage was originated or was rolled out, um, over the past 10 years, Quicken's mortgage market share has gone from 1.3% to 9.2%. That's a huge growth rate. That's almost a 19% annualized growth rate. So they've really been successful in revolutionizing a highly inefficient and fragmented industry.
Yeah, I mean, I think you hit the nail on the head there. And inefficient. I mean, that is whether you're buying a home or even refinancing, or I mean, if you're trying to open up a home equity line of credit or something. I mean, it is just it is a seemingly endless request for paperwork and pay stubs and documentation. And I mean, the only thing that really keeps you going at it is there's a light at the end of the tunnel, and you really need to get to that point. But it does feel like going through the process, you see all of these opportunities for it to be better, and it certainly does feel like the company itself is working to do that. I mean, they have a number of businesses that exist well beyond just Rocket Mortgage too. I mean, there's Amrock and Rocket Homes and Core Digital Media and Rocket Loans and whatnot. But when you look at the actual performance of this business compared to its competitors, I saw this in the S1. They said in 2019 we closed 6.7 loans per month per average production team member, compared to the industry average of 2.3, according to the Mortgage Bankers Association. So that's significant on its own. Now, they also said in 2020, as of now, year to date, that average has grown to 8.3 loans per month. So they're clearly doing more, seemingly with less. And I mean, yeah, from an investor's perspective, you have to like that, I think.
Yeah, and that's just kind of what I was mentioning about really leveraging technology to your advantage. The average mortgage lender does not use technology nearly as much as Rocket does, which
Yeah.
makes the process take longer. Now, to be fair, the 2020 number, you've seen a surge of refinancings, right? Interest rates have plunged to record lows. Refinancings are going through the roof, and refinances they generally are a quicker form of mortgage than a purchase. There's lighter documentation requirements. The people already own the home, so it's usually easier to document what you need to document and get the loan through the process. So that could be what explains the 2020 jump in numbers. But 6.7 versus 2.3 per team member, that's a huge difference, and it really shows the power of streamlining the process. And that's, like you said, from an investor's point of view, that's really a nice thing to see.
Yeah, it really is. And talking a little bit about how they make their money, you mentioned that they typically sell most of those loans off in the servicing market, which is yeah, that's obviously something that happens quite a bit. So yeah, I mean, the first question that really comes to mind is how do they make their money? And it sounds like they make their money mostly just from the origination of the loans, right?
Right. Every time you get a mortgage, there's some sort of origination fee attached to it. Think like $1,000 or so. And this is just a fee charged by the lender for putting the process of originating your mortgage. As you said, the average team member, Rocket's one of the most efficient companies, and the average team member can get through 6.7 of these per month. So the origination fee is what pays those people and is the profit margin for Rocket Mortgage. They also they sell the mortgages into the secondary market, meaning to like Fannie Mae, Freddie Mac, those type of agencies, and get paid for that. I mean, you're selling the mortgage means that the other party is buying the mortgage, so they get a little bit of revenue from that. And there's some other, they have like I mentioned, they have a servicing business, where servicing means that they, collect payments from borrowers and make sure the owner of the mortgage gets paid. So they get a little bit of revenue from that. They have, real estate referrals. I mentioned they also have an auto business. They have a personal lending business. These are all small compared to the origination business, but they have a pretty diverse revenue stream. Origination is their bread and butter. So that's really, so when you're looking at Rocket Mortgage as an investment, I mean, obviously we don't know how much the shares are going to cost yet. But when you're looking at it as a business, focus on the origination business because that's really the bread and butter of it.
Yeah, yeah, and I mean that you're right. That is a big business. I mean, when you look at the year ended 2019, they originated 145 billion dollars in mortgages, and 91% of those were actually sold to government-backed entities. I mean, that's selling that mortgage off. But I mean, you figure those government-backed entities. I mean, that's something they're used to doing, buying those loans, and you would imagine that they probably want to buy loans that a little bit more reliable than not. So, I mean, that gives Rocket, I think, the incentive to keep on writing good business. And you mentioned something, and I wanted to talk a little bit about this. Um, the shares, we're not going to know what the shares price at when they go public. We can look at some of the numbers at least and get an idea of what kind of money the company makes. It does look like at the end of the year 2019, they brought in $5.1 billion in revenue and net income of $893.8 million. So, I mean, it sounds like at least this is a business that would go public, and it's going to be a business that, I mean, it should be profitable from the get go, I would imagine.
Yeah, so if their net income last year was almost $900 million, based on, let's just say, a price to earnings of 20, or thereabouts, you're looking at almost a $20 billion valuation for this company. Is my guess on what it would trade at if it were to go public tomorrow, just based on that net income number. But no, that I mean they're definitely a profitable company. They're efficient. They mortgage lending, especially just if you're just an originator, is usually not a very high margin business. But like you said, their average employee is about 3 times as efficient as the industry average when it comes to mortgages originated per month. So that has translated into some nice profitability from these numbers.
Yeah. Now, in regard to the actual shares going public, I was kind of taken back a little bit by this at first, but I mean, I guess it's not really that surprising. I mean, this is a company that founder Dan Gilbert, who has he's been the one that really has spearheaded this company from the start, and he's going to remain really the one in control here. There are going to be four classes of shares. Now, there's not going to be four classes of shares that go public. I mean, there are going to be A shares. I believe the IPO is going to bring the A shares to the market. But I mean, there's class A, B, C, and D shares. And at the end of the day, this is still going to keep power and control of the company firmly in Mr. Gilbert's hands. He'll have 79% of the vote. Um, talk a little bit about this extensive of a share class structure. What are the advantages? What are the disadvantages of something? Is that something that gives you pause?
Well, anytime you have more than one class, the usual reason for it is to give a certain party voting power. So it's kind of a weird class structure. Like you mentioned, there's A, B, C, and D. Class A and C each have 1 vote per share in company matters. Class B and D each have 10 votes per share. So that's not an uncommon thing. We call those the super voting shares. But the weird part is that Class A and B shares have economic rights, meaning that if the company pays a dividend, they would get the dividend. If the company were to sell, they would get a share of the money. Um, Class C and D have no economic rights, so really they are just voting power. It's kind of the weird thing that I see. And the big sentence that in the S1 that really stands out to me is it says there will be no shares of Class B common stock and no shares of Class C common stock outstanding after the IPO. So that means the only ones that would exist are Class A, which has 1 vote and economic rights, meaning it's just normal common stock, and Class D, which has 10 votes per share and no economic rights, meaning that just gives people voting power. And that's Dan Gilbert's shares. That's the super voting shares go to insiders. It's the same thing you see from like Facebook. That's how Mark Zuckerberg has total control. He has super voting shares. Same with like Zillow has a dual click share structure. One has voting rights, one doesn't.
Yeah, I think
Uh,
Under Armour has that same
yeah,
basic setup
Google
as well.
Alphabet that has
Yep.
the same thing. And a lot of times the super voting shares aren't available to the public. Those examples, Google, Under Armour, they all sell their both classes to the public. Like in Alphabet's example, the GOOGL is the share with voting rights, and they usually sell for a few dollars more per share than the ones without voting rights. But in this case, you won't be able to buy the super voting shares. It's kind of the point. Um, the insiders control those. They're not willing to sell them to you. So if you want voting rights and if you want your vote to count, because public stocks are not always a democracy. Your vote doesn't always count. If you buy a share of Facebook, you have a vote, but Mark Zuckerberg's vote counts more than you. So it's not a democracy. And Rocket Companies is not going to be a democracy. So take that into consideration if that matters to you. It doesn't really matter to most retail investors, but if it
Yeah,
does,
yeah. I mean, that is something. I mean, I earlier in my investing life, I think I probably would have viewed it a little bit differently. But you're right. I mean, it really it's not a democracy, and you would like to think that maybe your vote counts, but at the end of the day, really, based on the structure of the business, you're going to be along for the ride, and so you're either okay with that or you're not. But we get questions from listeners and from members all the time in regard to share class structure. Should I buy the A or the B shares of whatever given company? And oftentimes early on, there will be somewhat of a spread, right? There will be a disparity in the pricing where, the market might be assigning a higher valuation to the stock, to the share class with the vote versus the share class without the vote, even though they represent the same economic interest. And I've always just felt on the side. I mean, I'm not going to pay up for that vote. Like if I have a choice, if there's a big disparity there, I'm not going to pay up for that vote because ultimately the vote doesn't mean anything. It doesn't matter. I mean, I don't mean to sound that straightforward about it, but it really is true. I mean, you've got an owner who's going to basically take the company in whatever direction they want to go. So every investor has to come up with their own way of looking at it. But really, I mean, what's the point of paying for that vote if that vote doesn't matter?
right. Well, and in a case like this, when it's just look at the company's track record since its 1995 founding. I don't mind having having
Yeah,
the insiders totally in control.
there's
I
a
trust
track
that
record.
I trust their vote more than I trust mine.
Yeah,
Same with like a Facebook. I trust Mark Zuckerberg's vote more than I would trust my own. I mean,
I
you
tend
can't
to
really
agree.
argue with. Look at the price that Facebook went public at, and look where it is now. I really can't argue with how well that he's monetized the site, and I don't really want to tell him what to do.
No, no. I mean, I'd imagine he knows that business better than we do, and I'm okay with that.
Right. There's a lot of, like say like AT&T or something like that, where nobody has the majority vote. Like, the public's vote can count. It's generally the funds that own it that really have the most pull. But, it's not the point is it's the shareholders actually making the decisions, not the leadership. But in this case, it's going to be the leadership making the decisions, not the shareholders. So it's just a matter of how comfortable you are with that as an investor. But a 19% growth rate in market share over the past decade, I mean, that's hard to argue with.
Yeah, and when we talk about large and growing market opportunities, I mean, this is certainly one of them. I wanted to get your quick take on the use of the proceeds. I think whenever you see an S1 filed, it's always helpful to, and they have this in the table of contents, so to speak. There, I mean, they need to list out the use of the proceeds, and oftentimes the use of the proceeds is to go towards growing the business, capital expenditures, whatever it may be. It seems like here that the use of proceeds a little bit of a different setup here. Can you talk a little bit about what the use of proceeds
Well,
here will be? Because
I
it's a little
actually
bit
just
confusing.
do you mind? I just lost that. It's worth pointing out to our listeners that this S1 filing is 3,178 pages long.
Yeah, it's a big one. But yeah, and if I read this off, I mean, I will read
I,
it so that
I
you
lost it
can
when I
hear
was
it.
looking at the share structure.
And yeah, it's I slacked you that one blurb earlier where they say we intend to use the entire aggregate amount of the net proceeds from this offering to acquire a number of holdings units and corresponding shares of Class D common stock from RHI, which is Rock Holdings, equal to the amount of such net proceeds divided by the price paid by the underwriters for shares of our Class A common stock in this offering. So I mean, it ultimately it doesn't. It sounds like this is going to be money that is used to ultimately solidify the ownership structure of the company, as opposed to being money that they're going to be putting to use in growing the business necessarily. Was that your impression?
Yeah, I found it, by the
Yeah.
way. It was right under the page I was looking at, out of the 3,000 whatever pages. That's the longest. This is the longest financial document I've ever seen. By the way.
Yeah, yeah. Thank
But no.
God for the internet, right?
Generally, when companies go public, there's one of two ways they can do it. You see what's an IPO, which is what this is going to be. And then you can see a direct listing, which means they're just listing the existing shares. Um, Usually, an IPO is done when the company wants to raise capital. Whereas a direct listing, Slack went public with a direct listing not long ago. Spotify is another example. Those companies went use that route because they didn't need to raise capital. It sounds like Rocket doesn't need to raise capital, but they're trying to get capital to essentially do some financial engineering with the share structure. But the key takeaway is they're not raising capital for the business. Usually, you'd see a note that we're using the amount of the proceeds for blah 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 and for general corporate purposes, which means that they're raising capital. So you're not seeing that here. It's not like they need this for working capital for the business. They don't need to go public. In other words, so
Yeah, yeah, that's what it struck me as too. I mean, this is the business has really already got its legs underneath it and been doing a lot of great stuff. And I think if we pivot away from the business side of things and look at the culture side of things, you can understand at least a little bit why. I think it's really interesting in the S1. They have a page devoted to culture and what they call their isms, their ISMs, and that's not an acronym. It's not ISM. It's their isms, and it's a list of 19 things. It's ultimately these are the ideals they live by that drive the culture of the business. And I mean, that's 19 things here. I mean, I think that's pretty encouraging to see. But then you look through those isms and you understand the ideals here. I mean, I think it's I'm at least encouraged to see a company with such a focus on culture, with their own way of looking at things. The isms, for example. I mean, that seems kind of foolish in my book. Capital F, foolish, right? I mean, we do those same kinds of things with our culture. You develop a culture that's unique to your particular business, to your particular situation here, and I think that Rocket Companies has done that too. I mean, one of the isms there is always raising their level of awareness. Another one is every second counts. Another one, a penny saved is a penny. But my favorite, and this is maybe the dog lover in me coming out, 16, we eat our own dog food. It seems like just another way of just saying they're doing what they say they're going to do. They're going to eat their own cooking, so to speak.
yeah, this definitely seems like a foolish company. In Well, I mean, just one thing that stands out to me about them is they were JD Power's number one rank for mortgage servicing client service for the past 10 years in a row.
Yeah.
And it's actually in full disclosure, Rocket Mortgage is actually a sponsor of this podcast not long ago. They've been a sponsor of ours in the past, and it's probably because we share a lot of the same ideals, and they're a very foolish mortgage originator. But I like the list of isms. I think that's a really cool touch. I think we need a list of isms.
Well, maybe we could get cracking on that. That we could help define these next decades of the Motley Fool with some isms of our own. Maybe we'll talk after we get done taping. A couple other ones that I really liked. 17, I live my life. Simplicity is genius. I love it. And then 18, innovation is rewarded, execution is worshipped. And I think that's exactly right. I think that's exactly right.
That's a great rule for every investor to live by. That one, I think that's my favorite out of them.
Yeah,
An idea is great. If you can't execute on it, then what do you got? So,
exactly.
it's that kind of goes along with what I said before that a great product doesn't necessarily make a great business. If you have a great idea for a product, that's fantastic. People are going to buy it. But if you can't make it work as a business, you're never going to make any money off of it. Um, there's a few of those that I mention all the time, and I get a lot of flack for them, so I'm not going to say them again. All the companies that I think are great products but not great businesses that the stock keeps going up and 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 up. I think you know what I'm talking about.
I do. I think I do. But we're not going to get into that on this show. That sounds like it'd be better for something like a Thursday, maybe. Um, Matt, I want to ask you in regard to Rocket Mortgage. I mean, obviously, the housing market and financing mortgage and all that stuff. I mean, are banks the main competitors here? I mean, is Rocket Mortgage, is that their main competitor, like a Wells Fargo or a JP Morgan?
Yeah, their competitors are definitely other originators. It's worth mentioning that Rocket doesn't own its mortgages. It's not a buy and hold lender, so there's no credit risk involved. So it, I'd say, and the reason I mention that is because some of the other lenders that you see retain some of their mortgages as investments. If you look at like Wells Fargo's loan portfolio, I believe there's some mortgages on it. If you look at some of these other big banks, they own some of their mortgages. If you make what's called a conforming mortgage, which is under a certain amount of principal, you can sell it to Fannie Mae or Freddie Mac if it meets certain guidelines. If you originate what's called a jumbo mortgage, you can't do that. So you could either sell it to a third party investor or retain it on your balance sheet, just to name one example. So they compete with them in the origination business. They don't compete with them in the sense of they don't own any of their mortgages. They're purely an originator servicer. So a lot of these other companies, like Axos Financial, a company we've talked about a lot on this show, I know owns a ton of its jumbo mortgages, and collects the interest payments themselves. And if a borrower defaults on the loan, they lose money. So it's a different dynamic than some of the banks, but most banks do have big lending, big origination operations. So in that sense, they're competitors.
Yeah, and I mean, I guess that, it goes without saying that when you're an originator, you're selling that loan off to typically it sounds like really here a government-backed entity. I mean, that takes a lot of risk, off your balance sheet as well. So you're not stuck holding that bag if we run into when we run into the next financial crisis, so to speak. And I think that's always something worth keeping in mind. I mean, it reminds me a little bit of like your Visa or Mastercard. They see a lot of money flow through that network. They're not really on the hook for any of the debt, but they get a nice little service charge for making that business work and facilitating the deals. Rocket seems to be kind of that same sort of business model, I think. Well, Matt, I mean, at the end of the day, is this a business you feel like you're going to be interested in considering for your portfolio or for the service? I mean, obviously we want to wait and let the company go public and learn a little bit more about how they report and how they behave as a publicly traded company. But I mean, it seems to have a lot of the qualities that we certainly look for in good foolish investment, don't you think?
Sure. Well, I mean, to be clear, we don't know when it's going public. We don't know at what price it's going to go public. We don't know the ticker symbol yet, I don't believe.
We do actually. I
Oh, we
will
do.
say it's
Okay.
it's going to trade on the New York Stock Exchange. The ticker is going to be RKT.
Okay, there you go. Well,
Yeah.
someone had, but we don't know when, we don't know how much. Those are the two things that we don't know just yet. And we won't find out how much till, a day or two beforehand. So I love the business. I love the leadership. My fear is that it's going to be one of those IPOs that doubles the day of the IPO and becomes really too expensive. Like think of a lemonade IPO that we just saw.
Yeah. Yeah.
I could see something like that happen with Rocket, just because it's such an anticipated IPO. It's fintech IPOs have especially profitable ones
Yeah.
have really soared. So I'm worried about it more from a valuation standpoint. I'd love to be able to get in on the IPO, but I mean, let's be honest, that usually doesn't happen. Um, but no, I love the business. I like that they don't take credit risk. I like that they're purely an originator. I think it's a great business, especially in a low interest environment. So I'm just curious as to the valuation. That's really going to be the question for me.
Yeah, yeah, I think that's a really good point. We do see a lot of times that that big pop that just it fades away over time, and if they happen to report a bad quarter or throw out some questionable guidance, then the market really gives it back. But yeah, I generally thinking I'm with you. I mean, I feel like this is a large market opportunity. It's one that I understand. It's one that I think should remain large and growing for some time. So hey, I'm all for in making a system like this more efficient. It sounds like that's what Rocket Companies is set to do, and it sounds like they have the opportunity to go even really beyond housing. So we'll see how that shakes out, but we will keep an eye out for that IPO. And Matt, I appreciate you joining this week and talking more about this upcoming IPO and giving us your thoughts.
Yeah, always a pleasure. Hopefully, see you again in a couple weeks, and you have safe travels.
Absolutely, absolutely. Thanks so much. And that's going to do it for us this week, folks. Remember, you can always reach out to us on Twitter at MF Industry Focus. You can drop us an email at industryfocus@fool.com. Let us know what you think about Rocket Company's impending IPO, because it sounds like it's going to be a big one. As always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against, so don't buy or sell stocks based solely on what you hear. Today's show is produced by Tim Sparks, so thanks for making it happen, Tim. For Matt Frankel, I'm Jason Moser. Thanks for listening, and we'll see you next week.